You know that feeling when you just stumble into investing and you're totally lost? Yeah, you're definitely not alone. So today, we're going to break down the hard-won wisdom from one investor's personal journey. We'll trace their path from some pretty costly mistakes all the way to a clear, simple strategy. So let's just dive right in at the very beginning.
Listen to this. I just stumbled into it. That's how it starts for so many of us, right? It's almost never a class you take in school. It's usually a total accident. You see some banner ad online, or a buddy starts talking about some stock, and next thing you know, you're in the market, completely overwhelmed, and basically just crossing your fingers. And that brings us perfectly into Act 1, the accidental investor. Yeah, this first stage, it's all about that chaotic, totally uninformed dive into the world of finance, where every single move you make feels less like a strategy and more like a trip to the casino.
And oh man, these first steps are just so relatable. It all kicks out with something like a banner ad for FX trading, promising easy money. And the strategy? Well, there isn't one. It's pure guesswork. A coin flip, a 50-50 bet on which way a currency is going to go. And spoiler alert, you almost always lose money. So what's next? You start picking stocks based on what you know. Oh, I'll buy BP after that big oil spill. Or, hey, I use Amazon all the time, I'll buy that. It's pure impulse, absolutely zero real analysis.
So that leads us right into Act 2, learning the hard way. After the whole do-it-yourself thing blows up in your face, the next logical step seems to be, okay, I'll just trust the experts. But as we're about to see, that can be a whole different kind of trap.
And you can see the progression here. It's so common. First, you give up. You outsource all your decisions to some platform that picks funds for you. Then you start hearing the buzz about a star fund manager. Think of the now infamous Neil Woodford fund. You jump in, totally trusting the hype. But what happens when that fund completely collapses? Well, you face the music. And you learn a really, really tough lesson. Blindly trusting an expert without knowing what you're buying, well, that's just a fancier way of gambling. And that right there, that's the rock bottom moment. After losing a chunk of your money like that, the feeling is just, this is not for me. It's that moment of complete and total disillusionment. You realize everything you've tried so far has been a massive failure, and it forces you to look for a completely different way. Which brings us to the major turning point in the story. Act 3, the passive investing revelation. This is where our investor discovers a simpler, quieter, and honestly, kind of boring path that ends up changing everything. So what exactly is this big revelation? It all comes down to the passive index fund. Okay, let me break it down. Instead of trying to find that one magic stock, that needle in a giant haystack, you just buy the entire haystack. Simple as that. A global index fund, for instance, lets you own a tiny little slice of thousands of the biggest companies all around the world. The whole point is to stop trying to beat the market and instead just be the market. And when you put the two side by side, the difference is just night and day. The old way, it was all stress, picking stocks, trying to time the market perfectly, paying high fees for the privilege. The new way is about owning the whole market and focusing on time in the market, not timing it. It's low fee, it's low stress, and it's so effective because it's so simple. And yeah, because it's boring. All right, so this brings us to Act 4. Once you've got the right tool for the job, in this case, the index fund, the game changes. The focus shifts away from trying to predict the market and onto mastering something that's way, way more challenging, your own mind. Okay, we've all heard this a million times, right? The classic advice for picking stocks: do your own research. But seriously, what does that even mean? For a regular person, what does that look like? It's got to be one of the most common, yet totally vague pieces of advice in all of finance. And here is the simple, powerful punchline that just cuts through all of that noise. It's this: you can't research the future. It doesn't matter how many charts you look at, how many balance sheets you read, you just can't do it. And that's exactly why this idea that you as one person can outsmart the entire market, it's a total trap. Think about it. It's you against millions of other investors, professional analysts, hedge funds, super fast trading algorithms. The current price of a stock already has all of their knowledge baked into it. For most of us, trying to find some secret edge is just a losing game from the start. So, if that's true, if picking winning stocks is a losing game for almost everyone, then what's the point? Where should we actually be putting our energy? What's the real skill we need to master? It's this: your own psychology. The real battle you have to win isn't against the market. It's the one happening inside your own head. It's against your own fear, your own greed, your own impatience. Learning to control your own behavior, that is the single most important skill you can have for long-term success. And you see this idea echoed in some really essential books on the topic. You got The Psychology of Money, which basically says how you behave is way more important than how much you know. Then there's A Random Walk Down Wall Street, which really drills home that the market's movements are pretty much random, and The Millionaire Next Door. That one shows you that real, lasting wealth is built through saving and consistent investing, not through flashy spending. And that finally brings us to Act 5, a simple path forward. This is the grand finale, where all these tough lessons we've learned along the way come together to form a clear, actionable plan that pretty much anyone can follow. So, what does this practical strategy actually look like? It's really just 4 simple steps. Step 1. Use tax-advantaged accounts whenever you can, things like ISAs or pensions, to let your money grow without the taxman getting a cut. Step 2. Automate everything. Set up regular payments into a low-cost global passive index fund. Step 3, be consistent. I mean, relentlessly consistent. Keep adding money no matter what the scary headlines say. And finally, step 4, just let it go. Let time and the magic of compounding do all the heavy lifting for you. And really, that's the big takeaway from all this. The most important thing is just getting your money into the market for as long as you can, as consistently as you can. Forget about trying to be a stock-picking genius. The most powerful tools you have are time and consistency, period. So let's end with this. The goal isn't to be the best, smartest investor in the world. The goal is to be the investor who can actually stick with their plan when things get rocky. It's about having a sensible strategy and, this is the most important part, the discipline to see it through. So the final question really isn't about the market at all. It's about you. What's your plan?